economic updates. So this headline, one of the things that I recognize being an investor, being a client of our firm, is that we see a lot of headlines, and headlines, they're designed to sell papers, they're designed to get eyeballs on them. And oftentimes, people are making these predictions, and more times than not, they're wrong, right? And so the reality is, I think that's one of the hardest things being a successful investor, is you have to figure out what you're going to believe, what you're not going to believe, or you just take the approach, I'm going to be an investor. I'm going to be a long-term investor, and a lot of this economic data that I'm going to cover is just noise, because the economy is always moving. Economists all have different opinions, but I'm going to share with you some of the highlights of what's happening from an economic perspective. So if you all recall, within the last 2 years, we were seeing a lot of chatter around a looming recession. And now what you can see on this chart, this was in a Wall Street Journal article just a few days ago, that there's a bit more of a lower recession risk, and they're seeing more growth. And when we looked at actually the predictions, they were just dead wrong. The good news is now they're predicting that there's a lower recession risk. So hopefully they're right with this one. Then when you get into some of the data here, we're looking at GDP estimates. And you can see on this chart here, going through the actual GDP, which is in the black, and all the forecasts. And you can see the forecasts, if we look back to 23 and 24, were all too pessimistic. And from an actual perspective, we did much better. And it looks like as we come out into the second quarter, the data is going to improve. And then in the bottom right, we're looking at that the probability of recession over the next 12 months has really gone down. I guess, unfortunately, with my background, I studied economics. The economists have to make predictions all the time, and I would say generally they're probably pessimistic is one thing, and then they're just wrong a lot. So I just wanted to share what's happening from a headline perspective. Now I'm going to share with you some of my thoughts as we look through the data. So from a long-term perspective, we look at economic growth, and we look at what the composition of GDP, or gross domestic product, is. This is a chart that goes back to 2000 roughly, and it just shows that we've had this long-term trend of GDP, real GDP growth, meaning adjusted for inflation, and we're looking at like a 2%, which is fairly low, actually. We would like to see this real GDP be a lot stronger, but the reality is this is our long-term trend line. And when you look at where all the components come from, we do know America is very much a consumption-based economy. You can see that on the right-hand side, and so it just gives you a breakdown of where things stand. Now, what we're hopeful is with some of the technology and AI and potentially some of the regulations coming down, is that we're going to see an expansion of GDP, because obviously having a stronger GDP drives job growth, drives profitability, and so those are the things that we're hopeful that will come out of where we are today in the economic cycle. And then when we look long-term, this is really a fascinating chart to me. So this data goes back to 1950. And what we're looking at here is each of these bars represent a decade in time. And the top percentage shows growth in real GDP. And when you start thinking about, well, what drives the GDP? What drives the economic growth? And it's a combination of the growth in workers, so just more people here working, and then growth in real output per worker. So that's another way of thinking about productivity. So if you notice some of the challenges we've had, and I highlighted them here in this red box off to the right, it shows that we've had a much smaller growth in workers over the last 25 years. And our productivity, the real output per worker has come down, especially when you compare to the 90s or compare to the 50s and 60s. And one of the things that's going to be interesting to see how this unfolds is we do have a challenge with growth in workers right now because of demographic shifts, some of the immigration challenges that we're facing. The question becomes, are we going to start getting some real growth in output per worker, which is, again, productivity? And that's what we're hopeful for. And that way you can see an expansion of this growth in real GDP, because that's what's going to drive wealth over time, is we can get our growth in real GDP up. Additionally, by having that number improve, it puts us in a position to be able to, to service our long-term debt, to pay for liabilities like Social Security and Medicare. So there's a lot that is riding on the ability for us to get this real GDP number higher. And again, I think there's going to have to be a concerted effort to be productivity-based, but also a much more planned decision around how do we deal with the demographic shifts in the U.S. and how do we deal with getting more workers here, and making sure that we have a really vibrant workforce, which would include U.S. citizens as well as immigrants that will be coming in to drive the growth in workers. This is a slide on the dollar. So there's a lot of noise here. I think the area that I want to focus is on the left-hand side. And this just shows the up and down of the dollar, basically the US dollar. And it's relative to a basket of currencies around the world. And it just shows the ups and downs. So when you have the peak levels, which you can see at the very top of this chart, we're looking at, let me see if I can get this mouse involved. Back in the mid 50s, excuse me, the mid 1980s, you can see here the dollar peaked out. And then we had a period of decline where the dollar lost about 50% of its value. Then we saw a recovery of the dollar, then a decline. And we've now been through a fairly healthy dollar advancement, where so from March of 2008 through September of 22, we saw the dollar rise against a basket of currencies by about 56%. And year to date is kind of interesting. We're seeing the dollar declining around 11%. And so the reality is the dollar day to day is very volatile. It tends to go through these long cycles, and we've just been living through a really strong 15-year cycle. So our expectation is the dollar is going to stay strong but slightly weaken. We've already seen that year to date. And that has some profound impacts on the overall economy. Around how we import and export. And so, but we generally believe that a strong dollar is a good policy. But the reality is, because we are investors not only in U.S. and in international, it does impact earnings over a long period of time. And this was just more of an FYI to really understand the mechanics of this, but we're noticing here in 2025, the international markets are doing well because their stock markets are doing well, but also because of the dollar decline, it makes basically the value of those returns go even higher. When we look at consumer confidence, and so one of the things that when you think about what that means, consumer sentiment index basically measures how people are feeling. And this data is provided to us by the University of Michigan. It goes back, this chart, till essentially the early 70s. And it shows these periods of time, and I'm highlighting the one on the right-hand side, but you can see we go through these ebbs and flows, these ups and downs. And one of the things that this chart is designed to show us is that when sentiment is high, meaning people are positive, generally that means negative. That's negative for the markets, because when everyone is positive, what does that generally mean? That means that the money has been invested. If you're positive, you're going to be bullish. You're going to be wanting to invest in risk assets. When you're negative or your sentiment is low, you're going to be more pessimistic. You're going to be more careful. More of your money might stay in cash because you're worried about the markets. And so you can see where we are today. This is a very bullish sign. June of 2025, our sentiment is around 60. So it's on the lower end of this historical trend going back, over 50 years. And if you look at this box up here, this just gives you the data that supports what I just said. When we look at this period of time, we've had 10 sentiment peaks, which means people are optimistic. And then we've had 9 sentiment troughs when people are pessimistic. And the go forward return on the S&P 500, which means at the point of the peak or the point of the trough going forward, what were the average returns? And the peaks represented a 3.9% return average, and the sentiment troughs represented a 24% positive return for the S&P. So what this would tell you, it's kind of an old Warren Buffett line, is that you want to be fearful when others are greedy, and you want to be greedy when others are fearful. And this chart really resembles that because of the fact that we're seeing, so when sentiment is low, it really drives stronger returns on a go-forward basis. At least that's historical. We know past performance is not going to indicate future results, but this is a pretty long trend that's existed for over 50 years. Then we get into some of the inflation components. So we know that inflation's been a hot topic over the last several years, and it's mainly because what you see right here on this chart. We had inflation peak in June of 2022, which was primarily on the heels of COVID, which involved a lot of stimulation by the federal government. When you saw we saw a lot of money being pumped in. We were putting money in hands of consumers. We were putting money in the hands of businesses. We were printing money at the Fed. We lowered rates at the Fed. So all of these things in tandem created this inflationary spike. So the one thing that we always have to ask ourselves, because the inflation is a hot topic right now, it seems to be on a lot of people's mind, is was this just a one-time deal because of all the impacts of printing that cash, putting in the system, or is this a persistent inflationary risk? I would say that we are of the opinion, and share this with many other investment firms, is that this was just a temporary blip, which did result in higher prices, but that we're going to fall back into some normalized inflationary environment, which is, in the 2 to 3% range, which is a healthy amount for the economy. And I know we know that, like, you can see energy is a big driver of that. You can see shelter, housing prices is the dark blue. That's a big part of that. But we do believe some of the inflationary issues have now come back. We do also think that artificial intelligence is going to be a big driver of pushing down inflation, and we have a lot of growth ahead of us. And so, while this was painful going through this, because this chart basically tells us in a summary is that all prices essentially got adjusted by about 20 to 25%, which is a big jump. But now on a go-forward basis, inflation it looks like it's going to be more muted. For those of you who are, I guess, history buffs around interest rates and inflation, this just goes back to 1958, this chart, and basically the dark blue represents the nominal 10-year treasury, meaning nominal, not adjusted for inflation, and then it shows, where we peaked in the early 80s at 15% on the treasury, and then we are right now at about a little bit over 4%. And so this is just meant to show you that, the 1980s, 90s, and then basically the last 40 years has been a massive decline in interest rates. And that really shifted here post-COVID. So as we came out of COVID, you can see now we're looking at interest rates to be a lot higher. We do think we're going to normalize the 10-year treasury in the 3 to 5% range. And so we feel like as we look forward, that's going to be the range that the economy can function in, the economy that we should all get used to. And that, the periods where we saw, right here, basically when COVID first hit, we saw treasuries really drop down to almost that 1% range, which is not really sustainable. And it did cause some inflation as well. When we start looking at the Fed and interest rates, this is a question we get a lot, like, what do you think is going to happen with the Fed? And we've already seen that, coming out of COVID, the recovery and some of the inflationary issues, we saw interest rates spike up here. This is the dark gray, this line all the way up. It basically went from a 0% interest rate policy to the Fed funds rate got up to 5.5%. That has now come down. The Fed's cut rates by about 1%. And then you can see a lot of the projections. So the FOMC year-end estimates, which is this dark blue, that represents what the Fed's expectations are, is that they're going to be coming down by the end of this year to be at about 3.9 in terms of the expectation. And then their long-term target is they would like interest rates around 3%. So we're slightly elevated above that. But we do see the rate coming down over time. It's hard to know the timing of it, to be frank. There's a lot of factors that are happening. The stock market is hitting all-time high. Real estate's holding its own. Other type of alternative assets like cryptocurrencies are doing really well. So my sense is that we're going to see some rates come down and get closer to this, from the 4.5 range to 4, 3.5, 3. But it's likely going to unfold slowly over the next several years, barring some sort of shock in the system. And so we're trying to function under the idea that rates are probably not going up, and they might come down slightly. And that's going to have some ripple effects throughout the banking system, as well as real estate assets, things of that nature. But we don't think we're going to see a massive drop down or a massive increase, despite some of the headlines that we do see. If you're new to Vance Wealth and you're just uncertain about what's happening with your tax strategy, your investment approach, or you just want a second opinion, we'll do a complimentary consultation. So please just reach out so that we can, we'll want to gather some documents, ask you some questions, and then we'll be able to give you a report that does a deep dive on your investments and your plan and give you some guidance, and maybe would be a good fit to help you on a go-forward basis. You can reach us. You can schedule an appointment. Just go to vancewealth.com. And you can schedule an appointment there, or you can call the office at 661-775-0950. Thank you very much. I hope you found our 2025 mid-year economic and market update valuable. Again, please like and subscribe on the YouTube channel, and we're looking forward to reconnecting in the future on our next video. Thanks.